So today's objective of the session's objective is to try to decode the tourism sector. For that, I have picked India's hotel and airline industry, since that covers majority of it. So diving right in, we'll start with the hotel industry. So how to look at the sector? First, so the entire sector is a very macro-based theme. So if you see a country like India, it is highly dependent on domestic travelers, unlike smaller countries such as Singapore or even what do you say, Philippines or Thailand, which whose economy is largely driven by foreign tourist arrivals, etc. But India has a large enough population that even though the foreign tourist arrival numbers have been lagging their pre-COVID numbers, the entire hotel industry has been performing like it's hitting home runs every year and it's performing really good. And another important trigger is infra and connectivity. So if you are seeing following the news and seeing what the prime minister is doing, so in the last few years we have set up a lot of roadmaps for what do you see rail connectivity through dedicated freight corridors such as Western Freight Corridor, Eastern Corridor. Then there's highway projects such as the Bharatmala Expressway projects. Then Udan scheme for connecting regional airports to our major airports across the nation. All of these factors come together and help the entire hotel ecosystem or tourism ecosystem flourish. Then there are niche such as events, concerts, cricket tournaments, sports tournaments, etc., which are also driving tourism. Now, how the entire industry is broken down. So, if you break it down very in a raw manner, so there are two kinds of hotels, which is the own model and the managed or non-owned model. So the own model is the old method, how it used to be done. So let's take the example of EIH Limited. So they own Trident Mumbai. So over there they own both the land and the property, as well as the brand is also this. So setting up such a hotel is very capital intensive and takes a lot of money to do so. Hence, even though the returns might be really good if you hit a good occupancy and your number of what do you say customers are coming in, your level of growth will be very slow because each time you set up a new hotel, you need to take a lot of debt or you need to make a lot of investments. So your speed of growth will be slow. So this is where the asset light or the management contract model is being followed. Over here, you may not own either the land or the building property itself will not be yours. So take the example of Taj. Taj Tirupati is the building, the hotel is developed by a local developer. Let's take example Prestige or Brigade. One of them, the developers, real estate developers, they have gone and developed the hotel property. So what IHCL, Indian Hotels, has done is they have just put their Taj brand on the hotel. And for that, they've gone and put the Taj brand and they've told the hotel property owner that we'll handle all the, what do you say, management of the entire hotel. The staff will be ours, we'll do all the branding, etc. Instead of that, just give us 5% of the annual revenues which the hotel makes. And if we perform well in the with the hotel gets good occupancy rates, high amount of customers are coming in, give us some incentive in the form of 1 to 2% of operating profit uh, as an incentive. So only 5% of the top line over here in the management contract goes towards the someone like a IHCL which owns the Taj brand, but 95% of the remaining revenues goes to the hotel developer. The reason being this is the hotel developer is taking up all the risk of taking debt to set up the property. He's paying the, what do you say? He's paying for the depreciation as well as for all the registration costs, etc. So uh, uh, ideally, that's why they should get more chunk of the pie, and Taj should get less. And in the previous model, someone like EIH, since they own everything from land building, brand, everything, they'll get 100% of all the revenue, profits, etc. So now I hope it's clear the formats. So knowing this is very important and it helps set a stage for what we are going to see going forward. So over here, if you see in 2001 to 2020, 2025, what has changed? The ownership model has drastically reduced in the number of total room shares, room count, which exists in India. And most of it has shifted towards the management contract model. And this is reflective across all brands. So ITC hotels, Indian hotels, Lemon Tree, EIH, all of them have shifted towards an asset light model. And this has helped, what do you say, clean their balance sheets, enable better cash flows, and also enable them to grow in a much faster and leaner manner. Since debt is no longer a problem, they can use their cash ideally in other forms of brand building and expansion. So all the developing headache is taken care of by the real estate players, builders. But this does not mean that they are not engaging in own models also. So some of the wherever they are able to find marquee properties in the city or in leisure destinations where they think they can make a lot of money, they'll go ahead and take the risk and set up their own hotel over there itself. Yeah. So how the entire industry has shaped up. So if you see the entire hotel industry, it works in cycles, which is visible here. So there are different business cycles, and it's all driven by the economy's performance. So if you broadly break down the entire industry, it's broken down into business travelers and leisure travelers. And there's nothing like business travelers are more sticky, so it's better, or leisure travelers give better margins, so it's better to have them. Uh, Having a blend of both business and leisure travels is very important. So over here, if you see, from since after the economy opened up in 1991, there was a lot of corporate travel from foreign companies, MNCs set up. So if you see here, the average room rates went up, the occupancy levels went up. But after the and all of this was driven mainly by foreign corporates, the demand. And even the stock market performed well from 2001 to 2003 to 2007. So in 2008, when the Lehman Brothers crisis happened, after that, all of that foreign money flushed out of India. So if you see again, occupancies went down, and room rates also started peaking down, going down from the peak. And this is where the bad times begin. Over here, what do you say? In the good times, mainly the luxury players were doing good. Now, in the bad times, uh, players like Lemon Tree, Ginger, that is the mid-scale hotel brands, they started expanding heavily because they could see that the lower room rates are an area they need to target in order to gain market share. And since the cycle always turns back, so there was a recovery mode with GST, demonetization, etc. A lot of the unbranded players, they went out of the market or they lost market share, and the branded players started doing good. And after that, we all know COVID caused a huge dip, and good times started with a revenge travel. And right now, demand is still very good, and occupancies are good. And if you see here, a very important point to note here is the peak room rate, which is around 8,000 to 9,000 rupees per night, which was reached in 2008, took a good amount of 15 to 17 years to reach back in 2025. So this just tells you that the headroom should be much more given the amount of inflation, and in real terms, the room rate has actually gone down. So ideally, it's cheap. It's cheaper compared to what it was 15 years to stay in a hotel in India. Yeah. Now coming to the branded hotel chains and the hotel developers. So in the listed space, you'll see like there are many hotel companies, but it's not properly bifurcated, and you're seeing from a blurred glasses. So if you see over here, Indian hotels, ITC hotels, EIH, till APJ Surendra Park, what's unique about these hotel companies is that they own the hotel brand. While Chalet, Sammy, okay, sorry, I repeated over here. Sammy, Brigade, these are developers. So they just develop the hotel. They do not have the IP, they do not have the rights to the hotel brands. So this is where I feel, me as an individual analyst, I feel uh, participating in companies which own their own brand, have their own IP, is much more safer and has a much more visibility in terms of future rather than going with a developer. Now, how the room count, types of room hotels have shifted over the years from 2001 right to 2025 and what is expected in FY30. So luxury as a share is expected to go down and economy is expected to go up. There are several reasons for this. One major reason being that luxury does well mainly in tier 1 cities and prominent leisure destinations, and real estate cost is very high for such locations. That's why it's tough to build hotels over there. And uh, and on the other hand, for mid-scale and economy hotels, you can expand in a large manner in tier 2 and tier 3 cities, since land cost is still low and there's economy is improving in these tier 2, tier 3, tier 4 cities. So expansion makes a lot of economical sense. Now coming to the next slide. This is just an idea about how what hotel has what all brands. So Taj, ITC. So what's unique about Taj, ITC, and Lemon Tree? What I feel compared to the other chains is that, um, first of all, they have a complete spread, like how you say a buffet, right from your economy to your medium to your luxury. So for economy, let's take the example of Indian hotels. They have Ginger. Then for business and mid scale hotels, upper what do you say, 4-star hotels, they have Vivanta. Then you can go to Taj, Claridge's collections, etc. Then they have something for your homestay like Ama stays. Then boutique, what do you say, nature based hotel chains such as Tree of Life. So same thing, ITC, Lemon Tree, they also starting to offer. So what's the best thing about this is you're able to play the India tourism story in a much better manner, and you're able to capture the entire audience, right from your leisure to your wellness, spiritual, business traveling, mice traveling, etc. All of these audiences you're able to capture in a much better manner. Something like a EIH will limit you just to luxury and upper scale. You'll only be able to capture a very high class or premium part of the society and won't be able to capture the masses, which is very important, I feel, given India has a high share of middle income in population. Now, how to read the industry? So the key terminologies are average room rate, which is what is your one night's room rate, occupancy rate, and the most important metric is the RevPAR, which is the occupancy rate multiplied by your average room rate. Average room rate multiplied by occupancy rate, which means how much revenue you are making per room on a daily basis. So 50% to 55% is a break even point. You need to have that much occupancy to not lose money. And once you cross the sweet spot, yeah, operating leverage will really kick in and your profitability will start growing very faster since these are asset based businesses. Now, what are the major hotels revenue streams? So majorly it's room count. It can be 50 to 60%. If you're more of a business hotel, your room revenue will be more higher, will be much higher than your food and beverage, etc. So your second category is food and beverage. This will include your banquet, uh, all your buffet, etc. Then there is other forms of revenue such as your shop rentals. You might have seen a Rolex showroom in a Taj or etc. Starbucks probably. Then there are membership, loyalty membership revenue, taxi service, you get revenue. Then, addition to that, there's that management revenue which I had explained in the starting. That will also add to your top line. Yeah, another point coming to that. So, what's the advantage of a management contract is you do not have to probably pay your lease, or you do not have to account for depreciation of your hotels. So that really helps increase your bottom line. Your profit will really grow. Now, top players in India, yellow ones are the ones who are listed. So you can see Marriott and Indian hotels are almost equal followed by Radisson, ITC, all the way to EIH and Leela. And here you can see how the mix has changed. Now it's 50-50 of the share of rooms in India are leisure and business, which is a good mix and it provides a good amount of stability and visibility. Cities and tourist destinations are obviously the two forms of locations. Now, this is an important part of looking at how the entire hotel chain scenario is broken down, the entire pie. So 12.8% of all hotels are branded hotels. So what I mean by branded hotels are hotels which are in a chain format. Your Taj, your Oberoi, Trident. Now 67% are unbranded. Unbranded means standalone hotels. Imagine any standalone local hotel chain in your city which does not have a chain. That's a unbranded hotel chain. Then there are aggregators such as Oyo, Airbnb, alternate accommodations. This has a gray line. It can also include Airbnb and hostels, etc. Now, branded rooms. This is only for branded rooms. I haven't mentioned here. So, how it has grown. So, it was 24,000 rooms in India. Branded means chain rooms. And it has now grown to 2 lakh plus rooms in India and projected to cross 3 lakh rooms by FY30. So, similar to how the cycle played out, there was shortage of rooms, and then builders realized that they need to build hotels in a massive way, and there was oversupply, 15% growth in hotel rooms, and then after that the economy collapsed, and for many years there was a lull. Now again, the what do you say? Supply has started picking up, and it's going to grow at a fast pace. So this stat over here is very important. So the demand in the future is expected to be around 200 basis at 150 basis points higher than the supply. So this will always ensure that occupancies are in check and room rates have scope to improve. And there is no oversupply scenario like how it happened in after the 2008 crisis. This is just an overview of how the revenues have changed. Around high single digit to low double digit revenue growth has been seen. Reason for this is because they're shifting to management contract models as mentioned, and the top line grows at a more steady basis. Where that is helping is now you see in the operating profit. So the operating profit pre-COVID, if you see, that is the EBITDA, it used to be 16 to 18% or much lower. You can see it's yellow over here. And post-COVID, it has increased significantly. Even though the revenue didn't grow as fast, your margins have really grown up because of the asset light model, as mentioned. Asset light model, which is management contract model. Same thing in the profit after tax. Now coming to valuation ratio. So these ratios are, these market caps are 2 weeks old. So it's just for educational purposes. So do not think that why is it not matching. So here you can just see that Indian hotels and ITC hotels, their P ratio is higher compared to the other things, other companies. This is mainly because of the stronger brands they have, as well as strong properties with good occupancies, as well as high visibility on future revenues. Same thing with Lemon Tree. Lemon Tree, even though it doesn't have a very strong brand compared to both of these, their revenue visibility is very high. Same thing cannot be told for EIH, which is lagging in terms of future projections. And the last one, APJ, the reason it's trading cheaper is because it does not have it has weaker brands than Lemon Tree. And on top of that, yeah, that is one key reason. Even though its revenue growth is expected to be double digits in the future. Now coming to their balance sheet positions, you see that except Lemon Tree, almost everyone's debt to equity is very low. So Lemon Tree is doing a demerger to solve this issue, which you can check it up on news to understand what's happening. Now future expansion and room count. Future expansion and room count. If you see here, almost all players are expected to grow very fast. With Indian Hotels and APJ Surendra Park, they are expected to grow the fastest. From 26,000 rooms, it will expect to go to 53,000 odd rooms for Indian Hotels, and likewise for others. You can see what are the occupancy levels here. APJ has high occupancies because it has legacy assets, and till now it didn't expand fast. So this is expected to go down as they expand faster. So emerging trends in the hotel industry, luxury wellness is growing very fast. There's spiritual tourism. There are other formats also. So Indian hotels, they tied up with a Maharashtra-based hotel chain called Atmantan. So Atmantan, they are mainly into wellness programs. So if you go to their resort in Maharashtra, you'll see that there's Ayurveda, yoga, different gyms, spa, gourmet wellness cuisine, etc. Everything to make you feel much better. So this is a niche segment which they are trying to fit into their large pie of hotels. This was something probably they felt there wasn't existing. Then there's the Ecotel certification. Basically, your hotel abides with all the environmental friendly norms and focuses on waste, water management, etc. And it's for customers who are more environmental conscious, and yeah, that's mainly the reason. Finally, IPOs in the sector. So in 2025, we saw very good IPOs. Leela listed, then ITC got demerged, Brigade, the builder, came in. Upcoming OYO is expected to list in 2026, and even Prestige Hospitality. So this covers pretty much the hotels part of the segment. Now to go towards the more turbulent sector, which is the airline industry, which has been in the news of late because of many issues. So let's begin. Fly in into this part of the segment. So many factors for the airline industry, how it has grown. So if you see the entire airline and ecosystem, it mirrors in a manner to how the hotel tourism sector evolves. So infra is very important. Domestic travelers is hugely important, and a lot of events and leisure and corporate activities need to go around this for the entire thing to work out. So if you see the airport count, it more than doubled. It's actually 150 something in 10 years. Your real average airfare has reduced by 25%. What this means is if it was like 10,000 rupees a ticket from Mumbai to Chennai, after 10 years also, 10 years also, 12 years also, it has been similar. But because your inflation has gone up, your real airfare you're paying has reduced. And another good thing is that the industry has consolidated, and that has helped improve competitiveness, provided an oligopoly kind of nature of the industry, and improved operational efficiency levels. Just to explain this part of why oligopoly structure is more efficient, I will, there's another slide in the next one. So if you see here, uh, Kingfisher, there were 10 plus airlines before this. So you can just see the entire chain of how each and everyone exited, and it went from 10 something to 4. Many issues happened. So taking the example of what happened in US. So from 2005 to 2010, uh, the entire airline ecosystem, it was really going through a transformation. So before this transformation, there were around 9 airlines. uh, and they were competing for a lot of resources. So it was highly fragmented. There were price wars, which caused a lot of slimming of margins. There was no optimization of routes, and there was high overcapacity. So once the number of players reduced to 4, and the industry became known for their big four airlines, which is Delta, American, Southwest, and United Airlines, a host of improvements was visible. Your profitability reached a record high, your operational efficiencies improved, route optimization came back, there was better network planning and better pricing power. Taking the example of many industries in India, so if you see why I'm saying that close to an oligopoly form of structure is helpful is India has seen it in many of the industries. If you take the telecom industry, which had like 10, 15 players, and all of them died, and now it's just 3 to 4 players with Jio, Airtel, BSNL, Vodafone, and their profitability has reached record highs. And a similar form of consolidation we are seeing now in the cement space, where their margins and revenue growth has improved, with Ultratech and Adani commanding more than 50% of the market. Although it causes a lot of pain in the transition period, in the long term horizon, if you see, the industry tends to do much better because each of the players, since they're lesser players, each will have to have will be able to have a better watch over their peers, and will try to take all the measures possible to try and improve their what do you say efficiency, and try to improve their edge over their peers. So what to monitor? Airport count I have mentioned. So 74 to 159, and it is expected to reach 350 by 2047. That Viksit Bharat, whatever the target we have set. And another key monitorable is the crude oil prices. So if you see here, crude oil prices have been, since the Ukraine war crisis, when it reached 130, $140 per barrel, it has reduced significantly to below $60 per barrel, and it is expected to stay flat or reduce further. There are many reasons for that. I'll explain, and this is a very good point because crude oil is helps make jet fuel, which is the major cost component, biggest cost component for airlines in operating the business. Now, why the airline industry is highly underpenetrated in India? So, if you see the domestic seats per capita for India, it is much lower than its peers, and even if it grows 5x, it'll reach what China is, and I think somewhere between Brazil and China is the sweet spot where India should land at, given its high population density, and the geography of India is also quite big. Hmm. Same ways, international seats per capita for India should reach somewhere between US and China, because Indians are yet to travel in a major manner abroad, and still most of the traveling is done by railways, and within airline is done domestically. So once international travel increases in market share, uh, it is expected to improve the international seats per capita. Over here also, if you see the number of fleet as of 2023, so this is some old data. India has 750 airlines, aircrafts, compared to something like China, which had 4,300. So even if we are able to reach half of this, because our population is higher than China, so even if we take a conservative estimate of half, 2,150 aircrafts, we can see this number triple. So the headroom is a lot for the airline industry, and if we go international, sky is the limit. Yeah. Hmm. So the business model. So how airlines they operate. So one is how they purchase the airlines. We'll come to that first. So there's an own model and sale and leaseback model. So the own model, suppose let's take the example of Indigo going forward for rest of the presentation to make it simple. So Indigo will go and purchase aircrafts from, let's take Airbus. Airbus and Boeing are the only suppliers, major suppliers in the world. It'll go and outright purchase an aircraft from what do you say, Airbus. The second method is sale and lease back. So it'll buy the flight at a discount and sell it to someone else and take it from on rent from them. So what this does is it helps to unlock capital, and it forms an asset light model of business. And further, this improves your ROE and ROC. I know this sounds very complex, but for the presentation, we'll keep it quick. So, what is the cost of a flight? So, a cost of a flight depends on whether you're buying a narrow body fleet or a wide body fleet. So, if you buy a narrow body fleet which has only one aisle, it costs you around 1,000 crores for an aircraft like Indigo. And if you buy a wide body fleet, which consists of your Boeing Dreamliner, that is 787, that will cost you around 2,500 to 3,000 crores per aircraft. What's the difference is this has one aisle and this has two aisles, to keep it simple. So this has lesser seats and this has more seats. And given that Indigo and Air India, they purchase in bulk all of their aircrafts, they get around 30% to 40% discount. So assume this will be around 600, 700 crores per aircraft, and this will be around 1700, 1800 per aircraft, or whatever, 2000 crores. How the market share has shifted? So you can, over the years, so Indigo has gained market share, SpiceJet has lost all its market share almost, and these two players have gained from SpiceJet's loss. And many of the airlines died on the way. So their market share also, these players took it, the top three. In domestic, Indigo is the biggest player, followed by Air India. But in international, if you see, the foreign airlines such as your Emirates, Lufthansa, etc., they have a large share. So if Indigo and Air India, they can, even if they try to reach close to their domestic numbers, then a lot of share of the pie is there to be won, given that a lot of they are shifting to a lot towards wide body aircrafts and aircrafts which can travel larger distances. So this will help them to capture more of the international market share. So type of lease under that sale leaseback model I told. So since all of the aircrafts which Indigo operates is on a lease basis, so they do not own any aircrafts. This is something which I need to point out, which is very important. So it helps to keep their cash flows in check, and assets are not asset light and cash flows in check. So this is very important. So within the lease, there are two forms of lease models. So a finance lease and an operating lease. So in a finance lease, so at the end of, let's say, a 10-year lease contract, Indigo will take ownership of the aircraft. But in an operating lease, at the end of, let's say, a 10-year lease contract, the aircraft ownership will go back to the lessor, which is the person who is giving the aircraft on lease. Now, within these two models, there's something called a dry lease and a wet lease. So a dry lease involves you only taking the aircraft on lease, while a wet lease involves you taking the aircraft plus the cabin crew plus the pilots, etc. Everything all inclusive on lease. So a dry lease is much cheaper compared to a wet lease, since you do not since all the points mentioned, and you can look it up. Yeah. Now coming to what is expected in the entire industry going forward. So this is the fleet size of the entire industry, 780 aircraft. Indigo and Air India, they dominate with 53% and 40% market share of the entire fleet count in India. This is the order book, how many fleet are going to, aircrafts are going to be added for them in the next 10 years approximately. So post expansion, what do you say? Their fleet share is expected to say similar for Indigo, but for Air India, it will drop drastically. This is because something like an Akasa, they are majorly expanding with 226 fleet being added. So they'll have 9% of the total fleet share whenever this order book gets completed. Now, order book by fleet is an important ratio. So if you see here for Akasa and SpiceJet, the order book, they are ordering 6 times their existing fleet for both of them, which will drastically improve their visibility of growth, even though there are question marks on their operational capabilities compared to Indigo and Air India. Other key metrics are daily departures. Indigo has much more than Air India and Akasa SpiceJet. Now, coming to the next point, key terminologies to look at. So, to see the profit and loss statement for any airline industry and to understand it, these four terms are very important. If you're doing any projection or if you're trying to understand what the management is saying, So first key point is ask, which is the available seat kilometer. To keep it simple, let's take available seat kilometer, which is your total airline's capacity in a year. To keep it simple, let's assume a flight has 100 seats and it travels 100 kilometers in a year. So that means 100 seats multiplied by 100 kilometers traveled in a year, that is 10,000 available seat kilometers. So this is your entire capacity for the year. Now, load factor is the occupancy rate. So if your occupancy rate is 80%, so you are able to do only 8,000 of seat kilometers of your 10,000 available seat kilometers. Then coming to your CASK and RASK. CASK is your operating cost divided by your available seat kilometer. This is basically operating expense. And RASK is your total revenue divided by your available seat kilometers, which is a revenue parameter. So your RASK should always be more than your CASK, which is your cost, to ensure profitability. This is a thumb rule. Now, coming to the fleet options. So, as I had mentioned previously, there are only two kinds of fleet, a wide body and a narrow body. A wide body, since there are only two providers, Boeing and Airbus, for Indian Airlines. So Boeing provides the 787, which is the most popular wide body aircraft for them, and Airbus offers A350. For narrow body, Boeing offers the 737, and Airbus offers A320. Uh, Coming to the types of services which airlines offer. So for airlines, they operate in two different models, a low cost model and a full service model. Now, to keep it simple, Indigo operates in a low cost model, and Air India, they operate in a full service model. Now, what this means? This a low cost model means airline will only provide you the facility to you to sit in the aircraft and reach your destination. They will not provide you any goodies or any food items or any drinks or any facility, any kind of luxury. If you want to avail that, then you have to pay separately, as you pay in whenever you travel in Indigo. They give you a menu card and you book your items. Then a full service, coming to a full service airline. So this is where an Air India comes into picture. So they provide you with food and beverages along with your airline ticket, and that is inclusive in the cost. So you do not have to pay extra for food, and the airline will bear this cost themselves. So the reason why Air India does this and why Indigo does this is an important matter too. So Indigo doesn't provide anything. Is to The main reason is to ensure better cost in check, and mainly to keep costs in check. And Air India, the main reason they provide food is because it creates a differentiation factor and creates one extra reason for you to travel by Air India. Now, revenue streams for airlines, majorly it's passenger tickets, followed by food and beverage, as I mentioned. A third factor is which might cross the food and beverage segment is the cargo business. All your e-commerce and logistics carriers, maybe delivery, etc. They have started using aircrafts of Indigo for doing any form of logistics delivery related stuff, and this is providing extra revenue for Indigo. Peer financial performance. This is just an overview. You can look at it. Nothing much to take away from this other than the fact that the domestic players are doing good so far. Let's see what happens in FY26, which has been a tough year. They have grown faster than their international players. Now, coming to your operating profit margins, if you see here, Indigo has much better operating profit margins than its international peers. This is given all the different, cost measures which Indigo takes into check to ensure that their margins are good and they're able to make good money. Now, going forward, what can be the key threats for the industry and what can take away the momentum from this fast growing sector, that is the airline industry. So there are many alternate modes of transport which are coming up, like the Vande Bharat train, the bullet train, which is proposed for South India as well as for West India, such as Ahmedabad Mumbai bullet train or Bangalore Hyderabad Chennai bullet train. That triangle is expected to be formed. So the key reason why this can be a threat is because bullet train has a much fast, which has a very fast traveling speed, and Vande Bharat, even though it's only doing 80 kilometers per hour, it can reach 160 to 180 eventually. If once the track speeds, once the new tracks are laid, which can accommodate Vande Bharat trains, which are made to travel at a much faster pace. So now going ahead, what we see for the airline industry is why there is a high headroom for growth in the industry and why we think that it's just in the early stages for this industry. So if you see in the domestic travel itself, the number of passenger count for airlines is 16 crores for FY25, while the same thing for railway passenger was 700 crores. So this means that 16 crore times people traveled. This means that 700 crore times people traveled. So this means that multiple people booked uh, what do you say, train tickets. That's why the number is much more than your population. So once you look at this in a metric form, this means that 2.3% of airline as a percentage of railway passengers is only 2.3%. Now, if we assume that these 16 crore people, many of them, most of them maybe have done a round trip. So this comes down to only 8 crore uh, individual passengers on a population of around 140, 150 crore population. That is around 4% of your population is traveling by airlines. Now, nothing stops this from reaching probably 20 crores, 30 crores once the affluent part of the population grows, middle income goes to upper middle income, etc. We can see this grow further. Now, in the international space, if you see Air India and Indigo, the number of destinations they cater to is only around 40, 45 approx destinations compared to all of your American airlines and your other major European airlines, which are catering from 150 to 270 destinations. So this number can easily reach 100 to 150 once the new wide body aircrafts and long distance traveling aircrafts come into their order book, come into their operations, and they will be able to cater directly to aircrafts to destinations in Europe and US. And this will open up significant revenue opportunities in the international space. Now, why Indian players have a high competitive advantage compared to international players in the international space? One is, if you see here, Indigo's line, the blue line, they have the lowest cost per available seat kilometer. That is the CASK, which I mentioned. Their operating cost is the one of the lowest in international across almost all airlines in the world. A major reason is Indian employee cost is one third to one fourth compared to a foreign airline cost. So this really, since employee cost is very high, this helps to really keep costs under check and profits maintained. Now, another key factor to look at for the entire industry is what the crude oil movement is expected to show. So, based on many estimates and many major institutions, what they have told is crude oil is expected to stay around 65 to probably even $60 per barrel in the future. And given that, taking the case of Indigo over here, crude oil consists of 30 to 33% of your uh, sales as a percentage. So it is a huge cost component. And if crude oil prices keep coming down, it will really help to keep your crude oil cost under check, and hence your gross profit margins, they are expected to improve. Now, coming to the reasons why I feel that crude oil will be under check. Two reasons. One is that if you see OPEC, which is the oil producing nations of the world, their $1 million barrel production per day, how much was it? 33 million barrels pre-COVID, and it dropped down to 29. Now it is expected to pick up back in the future, which will help provide enough supply in the world. In the world for crude oil, and this will help keep costs under check and prices under check. Secondly, is a greater level of dependency on renewables. So, in the last 5 to 10 years, solar, wind, and other alternate forms of energy, nuclear, have started taking away share from your non-renewables such as crude oil. And that is expected to reduce the demand for crude oil. And if demand reduces for crude oil, then prices have to remain stable or have to fall. Another reason why crude oil prices cannot or cannot, I won't say, do not look to increase in the future. Now, finally, coming to the future of the airline industry. So, given the recent Air India sad issue and Indigo flight delays and the entire turbulence which happened in the sector, the DGCA, which is the Department for Civil Aviation, what they mentioned is that we cannot have just 2 to 3 players um carrying the entire weight or the burden of the entire nation, because even if one airline fails, the entire travel ecosystem will come to a standstill, and a lot of economic issues will follow. So this is why they have given aircraft licenses to three new brands companies, which is Shank Air, Al Hind, Fly Express, and all of these are expected to start operations in 2026. The main reason is that if there are enough players in the industry, then such kind of issues which happened in the recent past can be avoided, and that monopolistic nature or high uh, concentration of the sector wouldn't happen. So that is one key reason. With all of these points in mind, the entire, what do you say, tourism space, hotels looks rosy still, and airlines looked very what do you say, lucrative till last year, before this entire turbulent times began. But if things start to settle down, and what was seen in the last 2 3 years, the smooth operations, if they come back uh, in the limelight, then we can forget about the recent turbulent times, and again growth is visible for both of these sectors. I hope I was able to convey the message very well, and provide you with something new which you can take away with you. And you can reach out to the ithought team, as I had mentioned. If you have any other queries about any other industry, we are always there to help you out. Thank you.